Hi, everyone. My name is Amy Highend with VRM Intel, and I wanted to welcome you to the second annual Vacation Rental Data and Revenue Management Conference. We're really excited that you're here. Just a few little housekeeping notes. My entire team is located on the Alabama Gulf Coast, so we may be experiencing some difficulties. So I wanted to tell you that today we have Corinne Oakey from Breezeway as a backup moderator. So she'll be jumping in case our internet and power starts to flicker out. So we have a backup plan and we're going to go forward in this hurricane. This first session I'm really excited about. We just wanted to jump in and actually show data, which is pretty exciting for our industry, Patrick. We haven't had it. And so over the last few years, we've had Scott Shatford at AirDNA and Jason Sprenkle at Key Data moving forward, but so has Smith Travels, or excuse me, STR, it's old habit. But what we're doing today is we're going to look at pretty much all three of you are going to tell us about the data sets that you're seeing. And what we'd like to know is what does the world look like in a post-pandemic travel economy? So I'm just going to turn it over to you and we'll just get started.
All right. Amy, thanks for the introduction and thanks for the opportunity to talk about this today. Certainly, there's no shortage of interesting data and trends to talk about in a post-pandemic environment. Unfortunately, the data is not all great and uplifting from a lot of the hospitality and hotel side, but we'll dive in and explain some of those trends and what to look for. A quick word about what I'm going to be covering in the next 12 to 15 minutes here, a quick introduction to STR for those who are unfamiliar. And then I'm going to set the stage by providing a look at the COVID impact at a global hotel level. We'll spend some time looking at broader US trends, and then we'll close with a deeper dive of some interesting market by market dynamics. So let's begin. STR, for those of you who don't know, we're the leading provider of global data benchmarking, analytics, and marketplace insights. We've been doing this longer than anybody, reporting on our metrics and performance for nearly 4 decades. And to date, we collect daily, weekly, and monthly accommodation performance data from more than 67,000 properties around the world in 180 countries. Again, we've been doing this for quite a long time. We get most of our data directly from the source, so we don't really include a lot of scrape data in what we're collecting. As we do with everything STR, confidentiality is really a core tenet. We never, ever, ever, ever report on individual property performance data to anyone other than the property. If you participate with us, your data is only ever used in the aggregate, and we have a host of isolation and sufficiency checks to ensure your data will never be isolated. And then finally, we're a neutral, unbiased source. We don't own or operate any hotels. We don't own or operate any short-term rentals, nor do we assist in revenue management. We'll tell you how you did compared to your competition, but it's up to you to make the most informed decisions and create strategies from there. All right, so at its simplest form, here's the building blocks of what we do, and this is going to set the stage for the data I present over the next few slides. On a daily, weekly, or monthly basis, we essentially ask for 3 data points. We ask for the number of rooms available in a given property, that's our supply figure. We ask for how many rooms have been sold, and that tells us demand. And then, of course, let's get down to dollars and cents. How much money was made off of those rooms? And that's a revenue figure. By looking at how many rooms were sold over available supply, it gives us a percentage of occupancy. And by looking at the amount of rooms revenue over total rooms sold, that gives us our average daily rate. And when you combine the inputs of occupancy and ADR, that tells you revenue per available room, which is a nifty little KPI that helps you understand the interplay of supply, demand, and pricing on property performance. With that out of the way, let's actually show some of the data. All right, so this is a pandemic world. To understand how COVID-19 has really devastated the global hotel industry, it helps to level set and understand what performance looked like at the beginning of the year. So this slide shows you a 7-day average of hotel occupancy across every submarket that STR tracks around the world. If you see red, that means occupancy is not doing so great. Green indicates stronger occupancy. Again, this is an average of 7 days at the beginning of the year, and it's not surprising to see occupancy levels like this coming off of the New Year holidays, a pause in corporate and group travel. So this is pretty standard to start the year, the first week into the year. If you fast forward 4 months, this was the low point for the pandemic. So this is the week ending April 4th. And you see, really, no matter where you look, a lot of red. The word unprecedented is used a lot to describe the impact that coronavirus has had on travel. And when we talk about unprecedented, we're talking both in terms of scale, the fact that really there's not too many submarkets that are immune to the impact here, but we're also talking about severity. In our 4 decades of tracking performance data, we've never seen occupancy decreases like we're experiencing today. And likewise, we've never seen so many temporary hotel closures like we have today. COVID-19's impact truly were unprecedented. Here's the good news. If you do fast forward to the more recent week ending September 5th, a lot of that red has gone away and we're back into that orange bucket, indicating occupancies hovering between 25 and 50%. In a normal scenario for the first week of September, that's not good, but given where we've been, we're certainly going to take it. To show you that occupancy progression in a different way, this is for China, the US, and Europe over the first few months of the year. Not surprisingly, China started its recovery a bit sooner than elsewhere because it felt the impact of the pandemic first. And then you see the sudden and precipitous decline in occupancy in both the US and Europe. But since that low point of April, things have been slowly, very slowly crawling back. So the 2 takeaways here is that occupancy is very far off where we typically are at this point. So occupancy is not strong by any stretch of the imagination. The good news, though, is that occupancy is at least trending in the right direction. Again, from where we've been, we're going to take any gains where we can get them. Just one final view, or to paint this picture a different way, here's a look at global hotel and demand percent change for the most recent monthly reporting period in July. And again, no matter where you look, you are seeing dramatic historical dips in demand of more than 50% in most of these regions, just to really emphasize and show you the impact of COVID-19. That's just a taste of a lot of the analysis we've been doing. If you have an interest in more, feel free to visit our website. Right there on the landing page, you can click that button for COVID-19 updates and analysis. We're doing blogs, articles, white papers, webinars. There's a lot more in there that I can cover in this presentation. We encourage you to dive in. With that, let's take a look at hotel performance at the US level. This is a slide we typically start with when we're talking about total US performance. It shows demand and supply annualized. And again, look at where demand is today. This is well off previous downturns we've experienced over the past couple of decades. In the early 90s, you have the savings and loan crisis where demand dipped into negative territory. It got a little bit worse right after 9/11, and then a bit more recently with the Great Recession. But where we are today after coronavirus, this is like nothing we've ever seen before, and it's going to take a long while to crawl back. The interplay of supply and demand gets you occupancy. So this is the percentage of people staying in your hotels, and we're doing year-over-year percent change here. And again, you can see the long-run occupancy trends, unfortunately, are pointing in one direction, and that's down. And it's down precipitously. It's down unlike anything we've ever seen before. That's me with my pessimistic hat. Let's try to spin this and find a silver lining by looking at ADR trends over the past few months. So we don't like seeing ADR decreases in any environment, and certainly not to this extent. But if I'm trying to put that optimistic spin on that, it's that ADR declines year over year each month are getting less bad. So if April was the low point, we hope it was, each subsequent month has performed a little bit better, where there's still pain, but the pain hurts just a little bit less. And we see that same trend line play out when we're looking at revenue per available room, where April was our low point. And since then, we're still decreasing year over year, but the rate of those decreases is getting a little bit more tolerable. So that was the kind of a look on a month-to-month basis. In this slide here, I want to show you hotel performance in July by class. So at STR, we group brands and properties based on a number of factors, including average daily rate and amenities, into several classes. Luxury represents the high end, and economy represents the low end, with a few classes in between. And as was the case in July, has been the case for much of the pandemic, the fact that the higher end hotel segments have been hit harder than the lower end. So while we're seeing decreases across the board, the decreases for both the economy and mid-scale classes are actually less severe than what we're seeing in the upscale, upper upscale, and luxury classes. Now, this isn't necessarily a result of a price point or people necessarily getting more frugal. The major driver of this is the fact that corporate travel and group travel, for all intents and purposes, has evaporated, and that's a significant driver of demand and revenues at those higher levels. So that's one of the major things that's contributing to this decrease in RevPAR. But no matter how you shake it, high end or low end, if you look at where we stand from an occupancy level, nobody's doing great. The lower ends, at least the lower end scales, at least can say they're performing above 50% from an occupancy perspective, but they are still well off from where they were in July of 2019 from an absolute occupancy percentage. The same is really true from an ADR perspective. If we kind of look at this, you can see that as a general rule, hotels are able to generate $20 less per room this year than they were at the same point in time last year. And that's just a natural function of less people are out hitting the road, you lose a lot of pricing power, you can't charge as much. So that's where we have been. Just to give you a sneak peek of where we expect to be going in the future, here's a look at the US hotel forecast. You could see that 2020, it's really a wash. We're experiencing a lot of pain. We're not going to be able to get out of this anytime soon. And we're going to experience significant decreases across each of our major KPIs by the time this year wraps up. If you look into 2021, we're going back in positive territory, which is great. But just keep in mind, it's going to take us well beyond that into 2022, 2023, and maybe even 2024 for some markets to get back to where we were pre-COVID. So again, this is a long road to recovery. All right, so just to wind things down, I wanted to give you more of a local flavor by showing you some performance trends per market. To set the stage here, when we're tracking demand percent change from week to week, I've told you that each week is getting a little bit better. And we were seeing some pretty good increases from that April low point coming back through June. But for the past several months, those week to week demand increases have tapered off. They're not as strong. And it's begged the question, is the summer travel season over? Leisure travel was really the source of a lot of the demand increases we've seen, because again, corporate and group travel have kind of disappeared. And as children return to school, as the weather starts to get a little bit cooler, and that leisure travel maybe drops off a bit, does that mean that this kind of recovery is going to plateau or slow down? You look at this data, it's maybe too hard to tell, but things have certainly slowed down. With the notable exception of this most recent week that you see circled here, we saw a healthy uptick, which is a reflection of a strong Labor Day weekend. So over Labor Day weekend, US hotel occupancy was 63.4%, and on Saturday of Labor Day weekend, occupancy was 69%, which is only down 2.6% from where we were Labor Day weekend Saturday of 2019. So clearly, there's pent-up travel demand out there. People still want to hit the road, and I think more people certainly will as soon as it's really safe to do so. If we're talking about occupancy, I just want to highlight some of our biggest winners over that Labor Day weekend. So this is tracking how much occupancy increased Labor Day weekend compared to the prior weekend at the end of August. And you see the big winners here: Fort Myers, Chattanooga, Illinois South, Knoxville, Mobile, Missouri. The main takeaway is that these are not the standard like urban cores, the New Yorks, the San Franciscos, the markets that really drive a lot of hotel performance in a normal cycle. This is a lot of regional and destination markets. And that's been a key trend and a key storyline from this pandemic period. We've seen a lot of travel demand shift from those traditional urban markets to a lot of the suburban, interstate, resort, and small town markets. And I know that it's something that Scott and Jason are going to talk about from the short-term rental side as well. For the week ending September 5th, just to show you the top and bottom performers from an absolute occupancy standpoint, again, top performers aren't necessarily like the huge standard markets that we would see here on a normal basis. Please note that that bump for Louisiana was a result of some displaced demand as a result of Hurricane Laura. And then on the low end, unfortunately, you see some markets fall here, and a lot of it centered around Hawaii, which has really suffered as a result of the pandemic, as travel into the islands has, for all intents and purposes, really just come to a halt. STR thinks about the world, the US world, from a perspective of top 25 markets. You see them listed here. The important takeaway is that of all of our top 25 markets, only 6 are reporting occupancy in excess of 50%. And then if we talk about average daily rates, only 10 have had average daily rates in excess of $100. So again, we are well off of where we typically are at this point in the cycle, or during a normal period rather. And again, one bit of optimistic news, Labor Day did give some pricing power for select markets. You see the bump on a weekend to weekend basis here in the likes of Miami, New Orleans, San Diego, Orlando, and Phoenix. So that wraps things up on my end. Just a few takeaways I want you to think about, remember from this presentation. The first, the COVID pandemic has had a significant impact on every part of the hospitality sector around the world. The earliest hit regions like China have made the most progress toward recovery. And while performance in the US is less bad with each passing month, the hotel industry still has a long road to recovery. Many markets aren't going to fully recover until at least 2022, and some even beyond that. And then last but not least, there are bits of silver lining, some optimistic news, as we saw on the Labor Day weekend. It provided a boom in many markets, particularly regional and vacation destinations, which has been a continued trend line during this pandemic period. So before I transition it over to Scott, I just wanted to flag the fact that Scott at AirDNA and us at STR, we did a joint research paper that was released earlier in August. It's accessible on both of our websites. If you go to str.com, for instance, click Data Insights on the top there, go to White Papers, and if you scroll through to August 10th, you'll be able to download that research paper for free, and it compares at a more detailed level the differences between hotel and short-term rental performance. So we encourage you to take a look there and reach out to us if you do have any questions.
I do have some questions, but I think I'm going to wait. I think I'm going to hold these until we see what Scott has to say. It's interesting. It's fascinating to see some of those markets. One quick question: when you look at markets like Knoxville, would that include? Is that a DMA? Is that like what would that also include Gatlinburg, Sevierville, Pigeon Forge?
No, I believe for Gatlinburg, that's carved out as a separate market for us, Amy, but I would have to confirm that. You're testing my memory of the full geographic.
No, that's okay. I was just curious. All right. Well, Scott, are you able to? There you are. I'm going to let you take it off. Thank you.
Thanks, Amy. Thanks, Patrick. Jumping in, a little background on AirDNA. So for those of you that don't know us, AirDNA has been around for a little over 5 years. Just a little toddler compared to STR, it's been around for 35. But we track all 10 million properties across Airbnb, Vrbo. We have over 10,000 customers in 60 countries around the world. And our goal at AirDNA is really to create a product set to help people make better decisions across the whole process of really operating and growing a vacation rental business, whether that's from selecting a property, buying a property, finding new properties to onboard, setting those listings up for success, pricing them perfectly every day, or benchmarking the performance of your property versus peers in the marketplace. We solve all of these needs in our Market Minder product, which is our core consumer product. So sort of how we think about the bricks of our building blocks is really about data. And obviously in this space with in short-term rentals with over 3.5 million operators across 10 million properties around the world, the data is very difficult to get to. And so, I think we pioneered at AirDNA the way to really understand how to scrape and model all the data being aggregated from Airbnb and Vrbo, how to partner with PMSs and channel managers to get access to about 750,000 properties' actual reservation data, and how to get individual hosts to provide this data via our platform. People can upload iCals and other methods of sharing data with us. So we have a pretty full, robust view of the vacation rental market from a variety of different sources. Sorry. Same here, agenda. We're gonna hit on 6 things here. We'll keep it pretty brief, but we'll talk about short-term rentals versus hotels. I'll dive a bit deeper into that research report that Patrick was mentioning. We'll talk about short-term rental performance across the US and a little bit across Europe. We'll talk about some booking behavior changes, some investment trends we're seeing in real estate for short-term rentals, and what the future looks like across the industry. So Patrick teed this up really well. So I thought it would be nice to show a couple of slides on that research report that we did with STR, really comparing the performance of what happened during this COVID time with hotels versus short-term rentals. We plucked 27 major markets across the world out to do this analysis. And the STR guys did a really robust job at making sure sort of as a very apples to apples comparison about what was happening across the market. We can see the hotel in blue. We can see rentals, hotel comparable in orange, which is studio and 1-bedroom hotel, studio and 1-bedroom vacation rental properties. And then in green, the 2-bedroom plus rentals. So we can see, hotels took a big hit, in the COVID. And that short-term rentals were a bit more resilient. They did see a hit through the end of March, early April, but started to see a recovery much quicker than hotels did. And I think, we've talked about this a bit in the past, that, people were using short-term rentals for different purposes. Obviously there was leisure, but there was also just this escape from major metropolitan markets. And it became clear pretty quickly that short-term rentals were sort of that preferred method of lodging for people looking to avoid congestion, avoid density, looking for large units, and looking to isolate outside of major metropolitan markets. These larger short-term rentals really started to perform well going into April and May. We can actually see that, the larger units, these 2-bedroom plus units, for the first time eclipsed the smaller units in terms of occupancy rate. And we see that going on over the last couple months, as well as that these larger units are continuing to perform better and these smaller units are continuing to struggle. I don't know how to go to my next slide. 1 second. We'll get there. I think another story is ADR. ADR has remained relatively strong, and we've been really, really surprised about it. I think in this slide, we're talking about occupancy and ADR, which equals RevPAR, which Patrick explained in that previous presentation. But I think what we've been really surprised to see is that these larger units have a lot of pricing power. There's high occupancy rate, that these units are pricing even higher than they were last year. And we just see that as consumer preference. People are choosing these 3-4 plus bedroom places, especially in these rural destinations, traditional leisure destinations. And we aren't really seeing the impact on pricing, especially as we get to the bigger units. The smaller units, are pretty flat year over year in terms of what their rate is. I thought I would just talk about Gatlinburg since it was mentioned, and I know there's a lot of operators out in this region. I think while there's a lot of differences between the hotel and short-term rental market, there's a lot of similarities as well. We can see the same trend versus leisure markets performing really well, and in many cases performing better than last year, better than they ever have in the past. While the cities are struggling to recover. And this visual shows in blue the hotels again. And we can see sort of at the peak of COVID, hotels were down 92% occupancy, short-term rentals were down around 50%, but Gatlinburg recovered with the hotels up 1,300%, 2 or 3 months later, and also the short-term rental market was up over 100% occupancy, while Nashville has struggled to sort of recover as quickly. So we see, this story throughout, whether it's hotels, whether it's short-term rentals, that these destination markets are performing extremely well. And we'll get into it a little bit more here in this presentation. So just talking a little bit about short-term rental, I thought I'd give some love to our European audience out there, just talking about the market in general. So when we're talking about listings here, this is entire home listings across all of Europe. And we'll see this trend throughout, is that supply is down. And this is surprising because it was remaining pretty stable early on in COVID. But we've seen about 500,000 properties disappear from the European market over the last 6 months, which is about 17%, or 25% of listing nights, which is the actual nights available in the month for every listing. So down to about 50 million from 67 million listing nights available. But the demand side isn't as bad. Occupancy is down 7% in August, which is Europe's best month of the year. ADR is relatively stable, helped out by some currency here from the euro to the dollar, and RevPAR is really down 4%, but not a big deal considering the environment that we are in. So for the US is sort of a similar story. We actually have seen a lot of listings disappear from the marketplace, about 15%. I will jump into supply numbers here in a little bit, actually, but we see demand still being high, right? And that could be a factor that 15% of the supply has disappeared, that the demand is still there. And so these properties are still in the market, are in the right locations, are seeing really solid occupancy numbers, especially in the peak of summer in August. Really still strong ADR, mostly driven by these larger properties getting booked and not these studio and 1-bedroom properties getting booked, as people's preferences are towards larger units. That is sort of driving ADR up across the market as well. So I want to talk a little bit about this STR Index. A couple of years ago, we created this STR Index here at AirDNA, and what this is really looking at is the performance of the market across the US. What we did is we looked at the average revenue being generated by every property in the top 50 markets across the US. And then we segmented them into 25 cities, 25 destinations. And so we can see we started in 2016 at 100 as the baseline, and we see nice solid growth over the last 4 years. I think this is a great graph to sort of emphasize the difference between how cities are performing and the destinations are performing. I think my legend is incorrect here now that I'm looking at this chart. So the orange line is the destinations, the blue line is the cities. And so you can see that there was a big hit to the cities right away, sort of a similar decline to what we're seeing in the STR chart, straight down, but it is starting to recover. And the destinations took a little hit, but recovered quickly. And in terms of revenue per property in the month of August, we actually see it performing even better than it did pre-COVID. So let's get into the cities. What cities are performing well, what cities aren't? I think, again, we're talking about destinations being the bright spot here. If we look across some of these mountain towns and some of these Florida beaches, we see really nice revenue numbers. I think the latest we have here is for July, but we see across all of these properties, thousands of properties in these major markets, we see average revenues being up in double digits, sometimes as much as 30 or 40% almost in Breckenridge. And so we see these properties performing really well. It is definitely, winners and losers market. Those fortunate enough to be in these destinations, in these drive-to markets, performing really, really well. And unfortunately for the people operating in these cities, Boston down almost 50%, New York down 40%, in their summer months. It is really sort of a tale of two types of cities. And I think this chart really shows that well. So diving a bit deeper into the sort of destination and cities, we at AirDNA can track where people are traveling from and where they're traveling to. So we can see pre-COVID, we looked at like, what are the top drive-to markets? What are markets with at least 1,000 rentals that have the shortest median distance travel to them? And we created a list of about 10 here, which are like the biggest drive-to markets in the US. And then we sort of said on the flip side, where are people traveling the furthest? And obviously you'll see Hawaii pop up here in these properties on the coast with a lot of European travel or travel from Asia on that list. And so this is another way to sort of think about this difference between these destination markets and city markets. It's a fly to versus drive to difference in many circumstances. So we could see that from the depths of COVID, we called it the week of April 6th versus August 13th. We can see that these fly to markets only recovered 37–40% of their revenue and occupancy, while these drive-to markets have seen a really nice surge in travel demand, revenue being up 138% for these drive-to markets, and occupancy being up 73% from the depths of COVID. And so this is one of the major trends that we're thinking about. And so understanding where your customers coming from, where are your feeder markets, how far are people traveling, is what we've seen is the biggest correlation between the winners and the losers and the sort of COVID era we're living through. I'm going to skip that one. So I'm going to get into now, sorry for my slides. So changing in booking behavior. So we sort of mentioned like, who's winning, who's losing, leisure, metro markets, what's happening there, but there's really an underlying trend here. All right, booking lead time changes. So what we've seen is that this is looking at all the bookings happening across our sort of source data set. And we're looking at what's happening to the booking lead time, that booking window, through pre-COVID to where we are today. What we saw is one of the most monumental shifts we've seen in booking behaviors is that people started booking immediate trips. And it makes sense. People were looking to flee the cities. They're looking to isolate somewhere. And they didn't have a whole lot of confidence in booking travel further in the future, right? With shutdowns and uncertainty about a resurgence. So we saw almost 50% of bookings happening with a 1 day, 0 day or 1 day advance notice. And very few bookings happening 3 months or more in the future. Now we've sort of returned to a new normal here, which doesn't look too different than what it looked like before. But what we see is not a lot of confidence in this 91+ day travel. What we see is that people aren't ready to book in many times, their Christmas holiday yet. People have a lot of uncertainty about what's going to happen, over 3 months in the future. And so the sort of booking window is collapsing. And we're seeing most of this booking happening within the next 30 days is 60%, 70% of travel is being booked for within the next 30 days, which is a big shift from where it was previously. God. All right, technical difficulties. Let's talk about supply trends. So with the supply trends, I want to just dive a little bit more into what we've been seeing across the platform, because I think it's not a story that's been told often enough, is that, with the supply growth on the platforms that has, with Airbnb specifically, has gone down through the coronavirus. What we see is that, Airbnb was having to list almost 300,000 new listings every month to sort of fill their leaky bucket of how many properties were leaving the platform. About 200,000 properties every single month leave Airbnb, and 300,000 are added. And what we saw during COVID is obviously not a whole lot of new vacation rental coming on the market, but also people, taking their properties off of Airbnb. That was because people were maybe moving into their second homes, or there was obviously fears about having, strangers living in your home, especially early on in this environment. But what we've seen is that the supply has come down from 7.7 almost million to just over 7 million, which is is a reduction of about, I think, 12 or 13% over the course of this 6-month time period here. And so that is interesting. But what we did see in August is a lot of reactivation of listings, properties that had gone dormant, gone silent on Airbnb, being relisted in August, and a nice uptick of 136,000 new properties globally coming onto the Airbnb platform. VRBO is actually a very different and unique story. I think their supply was relatively stable at just south of 2 million going into COVID. And then in March, we saw a really big uptick in properties on Vrbo. There's a lot of seasonal rentals on Vrbo. There's a lot of these places that are sort of quiet in the winter and come on for spring break and list through the summer. But we also saw the most new listings on Vrbo that we ever saw in March. And we know, and I think Amy's written a lot about this story, but there was a defection from Airbnb in March as they allowed everybody to cancel the reservations. We saw a lot of those people moving over to Vrbo, and that the supplies remained pretty stable, but about 2.3 million on Vrbo currently. So I think one of the things that we think about a lot at AirDNA and where a lot of our customer base is where are the biggest opportunities in the vacation rental space? We work with a lot of real estate investors trying to really isolate what are these best markets for investment. And so hitting on this really quickly is, I think with this lack of supply, especially as the markets change, a lot of these places by national parks in rural areas are performing really, really well. And sort of the numbers make a lot of sense for investment in short-term rentals right now. Here's sort of just a quick hit on some of the markets that we see performing well. And as we talk to the real estate market, as we talk to real estate agents, real estate investors, we're talking about how these short-term rental markets are really moving home values around the U.S. And I'm actually on an Inman panel today also talking about how real estate agents need to understand this market, because investors' appetite is very, very high at the moment, as people are looking at these home appreciations of the last 4 years being 55%, pigeon forward 65% home appreciation in the last 4 years. That's because these are the best investment markets in the U.S. and people are starting to pay premiums for vacation rental markets in vacation rental properties in these markets. And so I think real estate's really started to catch up and understand that the investment in short-term rentals is going to be driving a lot of the activity in the future. I want to end on one slide here since I'm having issues. So I'm going to talk about just what does the outlook look like. So this is looking at booking pace over the next 6 months. This means what is on the books today versus what was on the books last year today. And so we can see that we still have a pretty big gap. Even though we're showing good demand, good occupancy, good ADR, we are seeing 15% reduction in supply, and we're seeing that people are not booking as far in the future. And so we don't have as much predictability in what the future is going to look like. We can see this bump in November 22nd for Thanksgiving, but we can see it's still a massive deficit for where we are for the holiday season. And so, we see us being down, call it 20, 30%, through sort of October, but there's really into early next year because people aren't booking those 3 months in advance. People don't have confidence in travel that far in advance. Ski season looks like it could be pretty slow, and people aren't really booking their vacation, their Christmas vacations, New Year's vacations quite yet. But I think this really is the reason why data is becoming more important right now, is because all the playbooks of the past sort of been thrown out the window. Consumer behaviors are changing. Everything's being condensed in a shorter booking window, and so it's becoming a pretty interesting and dynamic market to be tracking at the moment. And I think that's it for me.
Scott, it's really great insight. And you answered some of my questions on how the hotel performance is comparing with the vacation rental, and also how it's comparing between urban markets and leisure markets. I'm going to go ahead and give this to Jason. So this is the way this is working. We have a second part of this session tonight, actually, at 6 o'clock Eastern time. that's going to look at Hawaii and Colorado and some of the Western markets too. But I'll if I can't get to my questions on this one, then I will save them for then, because they're not going away. Scott, great job. Thank you.
Thanks, Amy.
Welcome, Jason Sprenkle.
Thank you so much, Amy. Great to be with everybody again. I'll jump right in here. So looks like a slide that's out of order, but I thought given what we've all been through with 2020 and with the hurricane at Amy's doorstep this morning, it's clear that 2020 is not done with us. That I'd start with two very important thank yous. The first one, obviously, is to Amy for the vision to bring a better data set to kind of build on what Patrick and the Smith Travel team, STR, started with the hotels many years ago. Amy, since the day I met her, has had this vision that our industry needed better data. We needed it to run our businesses. We needed it to understand the trends in our areas, and we needed it to price. And we feel incredibly thankful that she brought that vision to our space, and that we've been able to be a steward of that data along the way with key data. So thank you, Amy, for your commitment to bringing this to us, and particularly what you've been able to pull off with this DARM conference. I wanted to just stop and say thank you at the beginning of this conference. And then secondly, I wanted to say thank you to all the property managers out there that have stuck through 2020 with us. It's been a hell of a year, pardon the expression. And we had a vision when Amy started this to just go knock on one door at a time and see if we could create what was essentially a co-op here of people that were going to share their data into this pool. We knew that accurate data was critical if we were going to run our businesses off of it, and didn't really know where that was going to lead us. And we've been knocking on one door at a time, and we're up to 1,600 of you property managers out there that are part of this grand experience or experiment with us. And our data is getting richer and richer, and you guys have helped us kind of become the gold standard for the data that's running your business. And just wanted to stop and say thank you. All the data that I'm going to show you today is data that's coming directly out of your systems. And I'm going to try to use it. So thank you. I'm going to try to use that data to tell you the story of 2020. When Amy and I talk about looking back at this crazy year, it's going to be a story, hopefully, that is not repeated, and we'll get back to some normal curves. But for most of the charts I'm going to show you, again, all 100% real data, all right out of your systems. And for the most part, just a 2020 curve, so we can kind of look at what's happening, and even more importantly, kind of try to digest what types of properties, what markets, or what types of units are performing well, which ones are hurting, and more importantly, what we might be able to do about it. So I'll start with just the overall US market, set the stage here with the January to December overall look at 2020, and just talk about where we've been and what's coming up for the next couple of months. And then we'll dig a little bit deeper into each of the markets. And so this is what we call the big three. We've been talking about them for a while. Adjusted paid occupancy in blue, ADR in green, and RevPAR in orange. So we're using unadjusted RevPAR here. 2020 in particular calls for a little bit of unadjusted RevPAR because we've got such an anomaly with the holds and the owner stays this year. And we'll show you a little bit about how that could throw off regular RevPAR. So when you see RevPAR in the presentation, it is unadjusted. And so I put some numbers on here just for ease of kind of talking through the year. We started off at number one there with a pretty normal year. We were up a little bit pretty much across the entire US. And then everybody's got a plan, as they say, until you get hit in the face. And we certainly got hit in the face with COVID. No need to belabor what happened in March, April, and May, as Patrick and Scott kind of showed. And then some markets stayed down there into the hotels, as you saw in Patrick's data, really have struggled to bounce back much from 2 to 5. Vacation rentals in the U.S. had a much different reaction. When international travel stopped and cruises stopped and markets started to open up, we had just a real fast rebound as each market started to open back up. And then summer across the U.S. for the most part, a little bit down in June still as we became comfortable traveling again. But for the most part, if you look, summer was good for the U.S. Shout out to our friends in Hawaii who are still struggling with the shutdowns over there, and some of the local markets who are still shut down. But overall, there was enough of a gain across the markets that were open and prospering that we had what shaped up to be there for the U.S. as a whole is just a regular good summer. And then we've been hoping for this number 4. We've been hoping for a September with kids out of school and people willing to, take a staycation and travel and get on the road for a bump in September. And we're definitely seeing that. I will point out there that the ADR is lagging behind the occupancy, as you can see there from the arrow. And so perhaps some money being left on the table, something for you guys to look at in your own markets if you're seeing that same kind of trend, which we're seeing across the country. And then 5, we're still filling in December, but for the most part on track with occupancy and a little bit down for RevPAR. So I won't dig into the rest of the world, but I just want to show you these curves without even really talking through them, so you can see that we're very fortunate to sit in the position of vacation rental operators and leisure markets in the U.S. for the most part. If you look at Europe, a completely different story. Europe vacation rentals to me look a lot more like Patrick's hotel curve, just not that full rebound that we've seen here. Here's a little bit of a breakdown, even in England, which you think might track a little bit closer to what the US is doing. It's certainly done better than France, Italy, and Spain. You still see that overall depression, despite a bump in July and August, still back down. So just a real tale of 2 different worlds in terms of what's happened with leisure markets in the US for vacation rentals versus hotels, and really versus the whole entire rest of the world. Same thing even in Canada, a little bit better. Seems like the same kind of market as we're having, but still much more depressed than the US market in terms of the recovery, if you pay attention for July until September in particular. So let's get to the stuff you guys care about. I want to talk about regions in the US, and so I thought it'd be first helpful for definitional purposes to show you how we map out these regions. All of them are a little bit slightly different. Most people on the West Coast, God willing, are still sleeping this morning, and we'll hit them this afternoon. And so I'm going to focus on New England, the Mid-Atlantic, and the Southeast, and kind of talk about this Atlantic Seaboard a little bit for those hopefully that are on the call this morning, and just give you a flavor of how some of those are differing when you dig into the regional level. And so we're going back to RevPAR here again. Same thing we were looking at the US, but when we pull the pieces apart, we can really see some differences in performances that are worth noting. New England in particular, I've marked up there Boston and New York. Not surprising, I talked to Melanie, who will be presenting a little bit later this morning, who runs our data team, and she looked at this yesterday, and it's what we expected. People fled out of Boston and New York and the major cities in the Northeast, and they went to these New England vacation rental units, and they hunkered down. Nobody wanted to be in the city when COVID was first hitting. Of course, New York was on fire, kind of the epicenter of the outbreak. And you really see a remarkable difference in how New England vacation rentals perform for purposes of RevPAR than the whole rest of the world almost. And then you see it kind of returning more similar to each other for June, July, and August, and a little bit different here in December in terms of how New England is behaving versus the Mid-Atlantic states. We still got a ways to go before December in terms of bookings, so I would expect that to narrow and those differences to shrink a little bit. But you can see the importance of paying attention to your regional data and even your local data when we look at this. So it's fun to look at the national data, it's fun to look at the regional data, but there's an awful lot of disparity happening, as Amy said, kind of the haves and have-nots. So it's important to dig into what's happening in your local market, and happy to help you with that. Here we're looking at splitting what we just looked at, except we're looking at it, taking the year, and we're looking at year-to-date versus rest of year, and that also tells a much different story. We've broken down a couple of places along the Eastern Seaboard to try to give you a flavor of what's happening. First, we'll start with the second one there, Greater Orlando, and you'll see some of that in the slides coming up. But Orlando is driven by Disney. Disney's not what you think of when you think of social distancing. It's also, in large respects, for many, a fly-in market, and it's also, lastly, an urban market. So it's got a lot of strikes against it, and it's just not seeing that performance for the previous portion of the year or the rest of the year that a lot of these other traditional leisure vacation rental markets are seeing. So you look at Florida, Alabama Panhandle, down 11% year to date, but a really remarkable fall. And I think that's the story of this slide, is the Eastern Seaboard traditional leisure drive-to markets, particularly the affluent markets like Outer Banks, just seeing a tremendous rest of year. Same with Texas Gulf Coast, and same with Tennessee Smokies. And so, You know, we're seeing a lot of that in September. I think kids are starting to get, at least the ones that are in my social circle, are starting to get anxious, perhaps parents more so, to get the kids back into school. So we'll see if that shrinks some of this staying in a vacation home and the bump we're getting. But for the most part, rest of the year on the East Coast is looking considerably better than the first half of the year. Next thing I want to talk about is I kind of want to dig a little bit deeper into the previous part of the year and then split it into the rest of the year. So first, let's talk about what happened already this year. We'll look at year-to-date numbers. And it's really a tale of two different events here. First, the reaction to the policy decisions to shut things down. And that was not just across the US, as you can see here in this first view of cancellations during March. You see cancellations both on the West Coast and the Southeast, just really universally increase or spike beginning on 3/9 and then a peak around 3/18, 3/19 in terms of cancellations. And this is when we were all kind of in the depths of it and canceling everything we had on the books and really trying to figure out if our businesses were going to survive. And then, as illustrated here with Amy's hometown of Baldwin County, who's in our thoughts today with the hurricane, as soon as they could open back up, the question was the pent-up demand there? And I remember doing an awful lot of webinars with you guys, and the question is, will that pent-up demand pay out? And you can see just the precipitous rise the day that it opened back up. You had a massive spike in bookings there in green, and then the question of when they booked for, back to Scott's illustration, it was 1 day, 2 day, 3 days out. So it was, we're ready to come now. And you saw that just spread across the eastern seaboard as each market began to open back up, and that resulted in that giant spike in the beginning of, or the end of spring there, as we started to kind of climb out of COVID and begin to get comfortable traveling, but only comfortable within that short booking window. So let's switch now to the rest of the year, and I'll direct your attention to the kind of the August, September timeframe there. You can really see that the guest bookings per property here, not too different. We typically expect all three of these to stay pretty close together as they were in the beginning of the year. You see them spreading out a little bit, Mid-Atlantic doing a little bit better in terms of your number of bookings happening. And you recall the last curve, Mid-Atlantic was still down for the end of the year, doing a little bit better booking here, as you can see. So we're hoping, since these are reversed from the last slide, that'll bring that gap down between New England and Mid-Atlantic for the December timeframe. And you'll see a little bit better bookings before the end of the year for the Mid-Atlantic. Talk about a couple of trends now. Booking windows. We get an awful lot of questions about booking windows. And the story for 2020 is they got much, much shorter, but they're rebounding in short order. You look here on the left, this is the change in the shrinkage in the number of days that people booked in advance. And so really there in the peak, there was a loss of about 40 days of confidence there in terms of how far out they were willing to book. But as we creep into September and head towards the end of the year, we really expect those booking windows, subject to what this virus does, to return to close to normal. You see there for November and December, we've got a booking window that looks an awful lot like what it looked like at the beginning of the year. So this is critical for those of you in terms of thinking about your marketing and when you want to put marketing out there. For those in the ski markets, if there's anybody up early out there, really thinking ahead in terms of when people are booking out those ski packages and how far you want to get in front of them. And then as you guys begin to think on this coast about the spring break and the bookings coming in, we'll really want to keep an eye on these booking windows so you can put your marketing in front of people at the right time. Other big question is average length of stays. And this is a great illustration of why it's important to break out, the nationwide data into regions, and then you would see an equal disparity if you started to break this down further into your particular markets. Look at what a big difference it makes when you pull New England out of the numbers. Of course, when COVID hit and we had very few people traveling, the people who were traveling were heading out of the city, many of them staying in their own vacation rental units, but the Boston and New York, up in New England again, taking off, hunkering down outside of the city in these vacation rentals, and it really threw a giant curveball into the overall average length of stay data for the U.S. If you're looking at 2020 U.S. as a whole, be sure you're breaking that out, or you're looking at real different data sets. But then when you get back to June, if you take New England out of it, really for the rest of the year, maybe a day or two extra in the Mid-Atlantic states. In September, day or two less in the Southeast. But for the most part, average lengths of stays have returned for the whole East Coast, except for New England, where you're still seeing that exodus from the cities and people staying a lot longer even for December there. So it depends on where you are on average length of stay is the short answer. Owner holds and holds, or excuse me, owner stays and holds and their effect on occupancy. If you look in orange for these 4 areas, we're looking at the total occupancy. And a lot of people will just go in and look at the market and see what the occupancy is. If you're using scrape data in particular, you're typically just looking at the orange data set. What's critical is to look at what makes up that total occupancy. How much of it is paid owner occupancy or paid guest occupancy, which counts, how much of it is owner stays, and how much of it is holds. You look at something like Lake Tahoe, and this data is for June, July, and August. You got 23% occupancy in June, but 18% of that is a hold on the property for being shut down. So be real careful. Just a reminder, when you're looking at occupancy data, it's more important sometimes, particularly in years like 2020 or when there's an anomaly going on, say a fire or a hurricane or some of those things we're experiencing what seems like every day now, to break it down and distinguish between the components of your occupancy. How much of it is guests, how much of it is owners, and how much of it is holds. When there's something unusual going on, it makes an awful big difference. A couple of real quick slides on winners and losers. Condos versus houses. Condos got clobbered. Condos in blue here. People just not wanting to be close to each other. Kind of meets with hopefully what your expectations would be in a COVID pandemic. People wanted to spread out. Houses seemed safer. We expected that. We talked about that when we look back at 2020, a real fundamental difference here. Take things like this into account, obviously, when you're looking at pricing your condos versus your houses. If you're having a great year and you're up, doesn't necessarily mean you're up for condos. Getting a lot less demand for condos, you want to take that into consideration when you're pricing. Particularly here, if you look at the Southwest, just a real fundamental difference there in the performance of condos versus houses, and this is RevPAR versus last year, obviously. Another big trend, higher end markets are performing better than lower end markets, and this is a scatter graph where you've got a color for each market, and I don't have everyone labeled on here for purposes of simplicity, but if you look at the general trend here, what you see is markets that have a higher ADR, and we're using 2019 ADR so we can get a clean look at a high-end market versus a low-end market. You've got on the whole, and there's certainly some anomalies here, but you've got on the whole markets that have a higher ADR as a whole, or more affluent markets performing better than your lower-end markets. And part of the question we wanted to look at is, well, a lot of markets have a lot of condos versus houses, so maybe it's not so much high-end versus low-end, maybe it was condos versus houses. So we broke condos out of the mix here, and the trend became even more pronounced. So it's not just a proximity issue. If you look at just houses here for high-end markets like 38, where we are, performing way better than Panama City, which is a lower-end market, which is right next door to us. So same drive-in traffic, same weather, same everything else. A real disparity between your higher end affluent markets versus your lower end markets this year. Different to note than what Patrick's seeing at the hotel side because of the business travel issue. I think it is more reflective of the economic conditions where people who are just better off are still able to break away and travel during these times. Then another quick trend here, bedroom sizes. A lot of questions have been about, does it make a difference, not just if it's a house or a condo? So we looked at houses only here to eliminate that difference again. You see a pretty big difference here in September. All along, you typically see, when you're looking at this year versus last year, these property types performing about the same. You don't really get that gap. You get what you see there in February, March, and April. But if you look at September, kids out of school, you don't have a whole lot of people gathering their 3 or 4 or 5 families and going to stay in a 6 to 8 bedroom house. These were last minute decisions. They were perpetuated by last minute school closures or decisions to keep your kids out of school or decisions to work from home and go travel and stay in a better place. So you've got some people there in blue traveling just as a couple, but for the most part, this bump that we're seeing in September and October and perhaps going into November are families who are deciding to go stay away, and they're booking 3 to 6 bedroom houses, or 3 to 5 bedroom houses. And so something to consider also when you're pricing the next 30 to 60 days. Leisure, as Scott and Patrick pointed out, just performing way better than urban. I think everybody kind of expected that. We're looking at some of these markets that have a little bit of an urban leisure feel to it, like Orlando, but short answer with a few anomalies is definitely leisure markets vastly outperforming urban markets, and I think that's true of pretty much every hospitality sector. And then last but not least here, you can kind of see a breakdown of just how these urban markets are suffering. Fly-to markets, reiterating, way better performance than drive-to markets. And then last but not least, one slide and a list of takeaways. Really, if you put it together, condos are performing worse, small units are performing worse, fly-to markets, urban destinations. You put that into like a 1 bedroom in Honolulu, Hawaii, and you see really the worst of the worst. You compare that to a 6 bedroom house down the street in Watercolor, where you've got everything working for you. You've got affluence, you've got a drive-to market, you've got a private home, and you've got a leisure destination. And that's really the story of the haves and the have-nots. So the takeaway, strong fall for most people, but not everybody. Shorter booking windows that are returning to normal. Stay links that spike, that for most have returned to normal. And then the winners, affluent drive-to leisure markets, you should consider pressing your rates, particularly if you've got the right size home. And then just be very wary. You can see the differences in this data. Don't make assumptions based on regional data or national data or trends you're hearing. Look at your own data and keep an eye on it. Thanks so much. That's it for me.
Jason, thank you so much. For time, I am going to hold my questions as much as I don't want to until this afternoon, but I'm really looking forward to having that conversation. This was really good information. Just to give you guys some basic stuff, we have on the website, once you've logged in, there is a live sessions link where all of the things, all of the green titles, they're live. You can link and just go directly to the session. That's probably your fastest way to get there. The next session we have coming up in a few minutes is terminology and KPIs. And what we have, Breffney Noon, who is a professor at Penn State in hospitality and revenue management, is going to join Cliff Johnson, and they're going to take us through some of these KPIs that we just saw and really learn a little bit more about how they're calculated. We're also going to have a discussion with some of the technology providers about RevPAR, about the different ways it's calculated. Some of those things Jason talked about in terms of adjusted RevPAR, paid RevPAR, and RevPAB, RevPAN, RevPAS, all the different versions we have in the industry. I'm hoping that we can find a way to get on the same page there. So thank you so much. We'll go take a quick break, grab some coffee, and we'll see you in a few minutes. Patrick, Scott, Jason, great job. I'm looking forward to talking to you this afternoon. Thank you so much.
Thanks, Amy.
Thank you, Amy.